Good morning, everybody, and thank you for being here with us. This is Filippo, Lanza, the CIO of the Newman Funds. This is the monthly update for the Edge Invest Newman Credit Fund. The month of May was a good month for us, a strong month. We managed to deliver on our corporate long-short, our event strategy, and the macro side. I'll start with macro, which is quite relevant as we speak, given the news flow coming from the ECB today. Our expectation, obviously, as we discussed in the past, is that the ECB is quite keen and compelled by the macroeconomic data to exit the quantitative easing program. Apparently next week, mid-June, there will be another meeting, and it's quite likely that ECB will announce or pre-announce tapering for the end of the year. That would happen at the same time when the Fed is going to hike rates and possibly accelerate the balance sheet reduction over the summer. We do expect massive liquidity absorption from the markets over the next few months during the summer. We view that as extremely negative and bearish for fixed income market within the markets, and some of the central bankers being very optimistic about how low the monetary multiplier of quantitative easing has been. We've seen estimate in the single digits. We think it's very high number, way above double digits. So we think as they absorb the liquidity out of the market, we'll have plenty of disruption. The most overvalued asset for us remains core Europe, especially Germany, France, Holland, and then with it, obviously attached to that is periphery. But the main fulcrum of the valuation for us remained core of Europe, and we do believe because of inflation macroeconomic data, ECB will walk away. Consistently with that, we position the fund over the month of May. We're still positioned now. We still think the most overvalued is the bond, the most attractive probably the gilt, and in between Treasury and Japanese bonds. Because of the liquidity we do expect over the months of the summer, we've been reducing aggressively our inventory of corporate bond longs and financial bonds long. Has been an expensive exercise because the illiquidity in the market is atrocious. It's very difficult to liquidate positions, but we did it as we started at the beginning of May, and now we pretty much reduced our inventory to the lowest point we've had in quite a few years. We remain quite negative on the banking sector, especially AT1, lower tier 2, because it's very crowded trade, very crowded investment, very sensitive interest rate. Away from now on the corporate side, again, the technological winter we've been talking about for months now is in full swing. It's happening, and because of that, there's plenty of defensive M&A. We'll see more coming up. Those defensive M&A will be highly levered and will be very expensive for credit investors. Because of that, we remain quite negative on corporate sector at large, and we play on through the events, trying to be long the equity leg, but very short the credit leg associated with the same event. Specifically for this month, there's plenty of events. There's the Fed, ECB, discussion, European Council, a bit about Brexit, about the banking union. We do think it's going to be very, very volatile, and we remain very negative and position accordingly on fixed income, especially on the core side on Europe, starting from the German book. With this, I thank you very much for your time and staying with us, and I hope to speak with you soon for the next monthly update. Thank you very much.